The views, comments, and opinions of the following program do not necessarily reflect those of Morris Media Studios, MorrisMediaLive.com, or its affiliates. Listener discretion is advised.
Good afternoon, everyone. It is Thursday, May the 6th. I'm your girl, and you are here live with Mortgage Money with Shirley. Mortgage Money with Shirley. Thanks for tuning in to my podcast. We're here live in the studios at Morris Media Studios. And if you would like to subscribe and watch us live on our podcast through YouTube at Morris Media Studios, or on my Facebook page, that's Clear Sky Mortgage and Realty, or my personal Facebook page. Also, you'll see me at Shirley Nichols. And I'm also, for the first time, doing the live on Instagram as well. So hello, Instagram. Hello, Facebook. Hello, YouTube. So again, you all, thank you so much for joining in on this Thursday, episode 4. Okay, and we're talking about why invest? Why invest? So again, you're tuned live here with Mortgage Money with Shirley, and we're going to talk about episode 4, why invest, right? Okay, so this week alone, guys, I know it's only Thursday and we have one more day to the weekend, but this week alone, I tell you, I have been swamped with call after call and new buyers, because they're wanting to invest. So whether you're a seasoned buyer or you're a new kid on the block, now is the time. And, I get this question quite often, Shirley, when's a good time to buy? Now, if you have your credit intact, right? You have your credit scores. And right now, if your minimum score needed is only a 620, why aren't you investing? Why aren't you buying, right? So when I say your minimum score required is a 620, that is using our FHA platform, right? So there's two different sides that we go to pretty much. As a mortgage broker, we're going to either put you on a conventional or we're going to put you on a government loan, one or the other. If you go government, which is your FHA, your VA, your USDA loans. If you're going with the government side, we have programs, yay, that can put you in a home with a middle score of a 620. And then news alert, I also have a lender that will put you in a home if you have under a 620. You heard me. If you have a 600 middle FICO score, I have a lender that will put you in a home, okay? If you're middle FICO score. So make sure you hear me clearly. Not the high score, not when you call me and say, hey, Shirley, I've got a 600 FICO score and I'm ready to go. So I'm going to say, so how many 600 FICO scores do you have? Do you have just one 600 FICO score? And that's either with Expedia, Experian, or TransUnion. Those are the 3 bureaus that we use in the mortgage lending, right? We use Experian, TransUnion, Equifax. So if you call me and you say, I've got a 600, I'm ready to go. I'm going to say, okay. Do you have just one 600 score? Because guess what? That's not your middle score, right? So you'd probably need something like a 630, a 600, and maybe a 590, right? Then that 600 is your middle score, and then we're ready to talk. So it's very, very important that you understand that concept. As a mortgage broker, and I want to educate you, and I want to tell you some of the things that I've known and experienced over the last 28 years of my business career, I want to share with you some of the tidbits that I know. Hence the reason why I'm doing Mortgage Money with Shirley on this podcast. But I still get those questions, right? I still get those questions of, well, I've got the 600 score you talked about, or I've got the 620 score you've talked about. I know you do, but you need that to be your middle score, okay? Not your high score, not your low score, but that middle score. And again, remember, we pulled 3 bureaus, okay? We call that a tri-merge. We pull Experian, Equifax, and TransUnion, okay? So glad we got that out the way. But I just wanted to share with you guys because I get so excited that, like I said, this whole week has been a transitional week of call after call, buyer after new buyer. And it just gets me excited because you guys are ready to do the thing. Buying a home, buying a house, buying a piece of property, buying real estate is going to be one of your biggest asset purchases of your lifetime, right? You're buying and investing in something that's like $300,000, $350,000, $500,000, right? You're going to own a $500,000 asset that you can take with you from generation to generation to generation, So get started now if you've got the credit score. And then, of course, let's talk about the money. Okay, so talking about the money. Again, as a mortgage broker, I'm just going to keep it simple and just kind of bring it down to hopefully what you all can understand. And oh, by the way, let me give this housekeeping tip. If you have questions, comments, or concerns, and again, you're on Facebook or on Instagram, you can definitely leave me those questions or concerns. And I may glance down every now and again, checking the phone because I've got my phone on Instagram Live too. Because like I said, I really don't do this on Instagram Live. I've been doing it through Facebook and through YouTube, Morris Media Studios. So housekeeping tip, if you have questions, comments, or concerns, you can leave your comments on the Facebook pages or IG page, or you can call in right now to the studio, okay? You'll find us at 323-815-4204. 323-815-4204. This is a 30-minute segment, so after the show is over, I'll cut it off at about 25 minutes or so into the show, and then I'll answer your questions, comments, or concerns if you call in. Again, dial in. Phone number is 323-815-4204. Okay? All right. So got that out the way. But going back to this money thing, right? And like I said, as a broker, I just kind of want to bring it down to a simpler level of understanding, if you will. Just think of it as, your mortgage broker has two programs, right? We've got conventional and then we've got government. Okay? And each one of these programs will allow you to buy an investment, buy a property. Okay? But it's the type of that program which would talk about your down payment. Okay? So let's think about this. If you are a first-time home buyer, right? And you're wanting to buy your first piece of real estate, and I'm excited, you're excited. It is so very important that you have that relationship or you have people that you can work with that you can genuinely trust. What do you mean, Shirley? What I'm talking about is there's a lot of my people out there, you know who you are, that still want to get online, get on the internet, and Google and search for a loan officer or loan originator or a mortgage broker, or they want to search for a real estate agent. Nothing wrong with it. Your preference is your preference, but might I encourage you to go with people that you either have heard about, known about, or you're looking at on the podcast, right? Talk to those people that are local because those are the ones that are going to respond. And I say this more often than not. And I wholeheartedly believe this because this is the profession that I'm in. How you start that journey into buying your piece of property or refinancing your property, how you start that journey is kind of how you're going to end. And what do I mean by that? Well, if you're starting that journey with online, let's say, okay, right? And you find Jane Doe online. You call her on Monday. No phone call back. You call her on Tuesday. No phone call back. Wednesday, she happens to pick up the phone when you call her back out of nowhere. You call her back and she picks up on Wednesday like, hey, I was going to call you. See, that whole 2-day, 48-hour lag time, I don't know. That 2-day lag time can also make or break your escrow close of escrow date. It can delay it, all because you started out 2 days later. So be mindful of that person that has poor follow-up, who doesn't answer the phone, who's too busy to answer the phone. Last night I made my last phone call. Yeah, I did. I made my last phone call of the evening to a client at 9:15. I did. So what I'm saying is there's too much technology around here. You can reach me by email, text, phone call, fax. You can reach me on social media. There is no reason why I shouldn't be able to reach you. Follow what I'm saying? So how you start that journey is a lot of the times how you're going to end. So be mindful if you're going online and you can't get that person on the phone. Be mindful of that. So I say that to say, again, relationships are important, but there are still some people who feel like, well, Shirley's my best friend, or Shirley's my cousin, or Shirley's my auntie, or Shirley's my neighbor, and I don't want her in my business. Hello? I mean, you're trying to buy the biggest asset of your life. Are you going to go with someone who's online that you can't see, can't get a hold of? Or are you going to go with Shirley, who knows you? And so what if we're close friends? So what if you're my relative? So what if we're neighbors? But do you want the house? Do you want to close your deal? Do you want to refinance? And I'll tell you something. For seasoned homeowners who are just refinancing, you'd be amazed at how much little information I need from you. Okay? So don't get too bogged down with, I don't want that person all in my business. Huh? So refinancing, keyword, refinancing. You've already had the home. You're getting ready to refinance into a lower rate or pull out some money, whatever you're going to do. A lot of the times in this mortgage season, 2021, 85 to 90% of the time, I'm going to need one pay stub, maybe two, one W-2, and your driver's license, and I'm going to pull your credit. Yeah. And I know some people are thinking, but what about the assets? Don't you need to know what's in my bank account? Not really. So it just depends on, again, the program that you're going with, okay? So I'm talking about all this because our topic of today's 4th episode is why invest? Why invest in your future, your legacy, your generational wealth? Why do these things? So that you can build assets now, right now. And your property, again, I can't say it enough. Real estate is going to be by far the biggest way to go and your biggest asset. I mean, look at Donald Trump. I know he was the president and all that kind of stuff, but look at how he got his start into the financial guru, the billionaire that he is, right? Look at how he got his start. One house, one investment, straight out of college. He rented a row of houses, rented a row of houses because he bought them. So that's how he got his start. And that's how you amass real estate. That's how you amass this portfolio of millions and millions and millions. You know what I'm saying? So very important. And another thing, make sure when you're working with that loan originator or mortgage broker that they have either owned a house or they have sold a house of their own, you know, and look, clear transparency. I've owned several homes. I've bought several homes, but I also have been through that era where the market crashed in 2008 and I had to do a short sale. Yes, I did a short sale. So it's not a bad thing, but I'd rather have done a short sale than a foreclosure. So when I'm talking to you about this whole mortgage thing, kind of know what I'm talking about after 28 years. I hope I know what I'm talking about. But these are the tidbits I want to pass on to you. It's nothing worse than talking to a loan originator or a mortgage broker who really hasn't owned a home, bought a home, or sold a home, or, like I said, gone through a short sale, or gosh forbid, gone through a foreclosure. But true transparency, yes, I've had to short sell a property. In 2009, when the market crashed in 2008, I wasn't going to go through a foreclosure. So I advise you all to kind of work with people that know what they're talking about, right? Okay, so let's go back. We're talking about investing and buying your first piece of property, or we're talking about the seasoned homeowner buyer who's wanting to buy other properties, right? So as a first-time home buyer, now going through this week alone, like I said, I can tell you example after example, but I want to talk about if you are interested in buying like a multi-unit, right? A duplex or a triplex or a quadruplex, right? If you're looking to buy a multi-unit, go for it. Go for it. And get a realtor who knows something about multiple units, right? Because I know what you're thinking. As a first-time home buyer, well, Shirley, how am I going to be able to afford this? And what am I going to do with the duplex? What you're going to do is you're going to get a roommate, right? Because if you're renting, if you are in an apartment right now, and these are some of the files I was working with this week, right? I just took them out of the folder. So I wanted to bring up one example, and I'm going to get to that here in a minute. But when you're renting an apartment, right? Or if you're leasing from a landlord, do you know how much you're paying in rent? Do you really know? Okay, let's think about it. For this apartment, you're probably paying for your gas and electric, right? And you're paying for that rent insurance, Hopefully you got rental insurance. I don't know. I don't know if you all have thought about it or you don't have it yet, but get you some renter's insurance, right? Renter's insurance. You can call your insurance company that that covers your auto, right? If you have auto insurance, call that person, get you some renter's insurance, right? So if you're paying rent insurance and you're paying the lease and you're paying gas and electric, right? You're thinking for that 1 bedroom or that 2 bedroom, you're paying like $2,000 a month. No, you're not. After all those other expenses are adding up, the renter's insurance, the gas and electric, the lights, after all those expenses are adding up, you're not paying just a $2,000 lease. You're paying like upwards of $2,500, $2,600. Do you know what kind of house that you can get for $2,500, $2,600 a month? Well, I'll tell you, right? Because I am this week, like I said, I'm closing a few deals this week. And one of the clients, let's take a look at this real quick. Okay. A $265,000 mortgage, right? And that's very, very low here in Los Angeles County. But let's just say you ventured out to San Bernardino County or we'll just use San Bernardino County. So let's just say you ventured out there. Your mortgage is $265,000. Do you know on a mortgage of $265,000 what your principal, interest, property taxes, and homeowners insurance could look like? I'll tell you, $1,575. I said it. $1,575 a month. That's with your principal and interest, your property taxes, and your homeowners insurance, the 4 components that make up your mortgage. On $265,000 a month, Shirley, my payment could look like $1,575. Are you serious? Yeah. Now, of course, there's some few underlining components that you must meet, some requirements like FICO score, So income plays a part. Your loan to value plays a part. There's a lot of stuff that kind of goes into that. But just think, if you owned or you wanted to buy a $500,000 property, your payment could be about $3,000, $3,100. Yeah. And probably a little cheaper than that. So just think of it this way, first-time home buyer. If you bought a multi-unit or a 3-unit, okay, at a $500,000, just think about how a monthly payment may be around $3,100. And you split it by 2. If you got a duplex, that's $1,500 a month. Or you split it by 3, that's $1,000 a month if you got a triplex. Yeah. And all these are real life scenarios. Or you can go back to renting and pay that amount and not own anything anyway. I don't know. I'm thinking rent. I'm thinking own. Yeah. So that's why I said, if your credit score is a 600, at least a 600, call me and we can talk about how to get you into a property. Now, if you don't want a multi-unit, that's fine. But I'm just saying, with a multi-unit, as a first-time homebuyer, yes, you can qualify with suggesting that you're going to have tenants in these other units, right? Okay, so if you're going to buy a duplex, right, a 2-unit, you're going to pay for half, and then you're going to have a tenant with a lease agreement. You're going to submit all this stuff to the underwriter, and you're going to probably qualify. Now, I say probably, and I use the word estimates because don't call me and get upset if I say, well, you don't qualify. I mean, when you work with me, I am a straight shooter, right? Straight shooter, no chaser. We just get to the business because there's no sense in running around the apple tree trying to pick a fruit that's ripe and it's not. So just let's get to the business, and I will show you or tell you what I believe is needed. Then, of course, the underwriter is going to tell everybody what's going to be needed. So I say that to say, if you are ready to buy that property, you've got the credit score and you've got the money. Now let's talk about the money. I'm so sorry because I mentioned the money earlier and I didn't finish with that. So on an FHA loan program, that's the government side, right? You can do a multi-unit and still put down 3.5%. Really, Shirley? Really? Now, some lenders require more for a 3-unit or a 4-unit, but let's just keep it simple, straight down the line. On a 2-unit, 3.5%. Not bad, right? So again, if you've got this mentality like, oh, I know, me and my sister, right? My sister and I, we can go buy this multi-unit. She can live in one side of the property, I'll live in the other side, but we need this 3.5% down. So guess what? Now you both put in 1.75 each. And, at the end of the day, if your sister or your brother or your whomever is going to go on this property title, okay, let's talk about that too for a second. Let's just say we've got Jane and John Doe, right? Brother and sister, Jane and John Doe. Let's say Jane's credit, women, shout out to the women, her credit is way better than John's. So we're going to use Jane on the loan because she has enough income. She's got the credit score, right? So the income and the credit score are fine. But the assets, part of that 3.5% down payment and the closing costs that go on top of this down payment, she needs a gift. Yeah, a gift. You mean to tell me, Shirley, that I can get money from other people like my family and my relatives? Absolutely. So we've got Jane and John Doe. Jane, girls rule the world. Okay. But let's just say we have Jane on the loan by herself and she's going to get a gift from John. Because remember, John's going to live in that other unit. So Jane's going to live in one unit. John's going to live in the other unit. John is going to gift Jane his part of this property. Now, even though, and this is very important because I think I get this question a lot more than I thought I was getting this question, but even though Jane is the only one on the loan, Shirley, well, can John be on title too? My brother wants rights to this property. Of course he can. Okay? Did everybody hear that? Whether you're doing a government loan, whether you're doing a conventional loan, the loan part of it has nothing to do with title. It does and it doesn't. But at the end of the day, whomever is on the loan and they want to add grandma, grandpa, auntie, uncle to the title later on, go forth. Go forth and do that. And the same holds true with Jane and John. If Jane is on the loan, and by the time we get to the closing, we want John on title, we can put John on title. Okay? John can be on title even though he's not on the loan. So the loan and the title are two separate things, right? And the reason why I bring this up now is when you're refinancing, and we'll talk about this government loan just for a tad bit. This government loan has a thing called an FHA streamline, or I'm sorry, I've kind of left out the VA. The veterans also have what's called an IRRL, or I'm going to get jumbled up with the with the acronym, but it's IRR, income reduced. Forget it. I'm not even going to go over what the acronym begins with. But the VA IRRL and the FHA streamline, both of those work the same. They're paperless, they're income-less, they're docless. They're just basically all you're doing is you're calling in and say, hey, I want to streamline this into a lower interest rate. But who's ever on the loan has to stay on the loan. Okay? And you cannot add people to the loan. So it's very important because I do get asked that question quite often. And I said, IRRL, income interest rate reduction loan. I'm so sorry. It just came back to me because I'm talking and I get all jumbled up. But VA IRRL, interest rate reduction loan. Okay, so that is your streamline, and it works just like an FHA. So again, I will say this again. The streamline is a refinance for the government loan, the VA or the FHA. That's your streamline, and that will allow you to call your lender and say, hey, listen, I want to streamline or refinance into a lower interest rate. And the first thing they're going to say is, okay, who's on this loan? And you're going to say, I am, but can I add John? No. You cannot add John to the loan as a streamline, but you can add John to the loan because now he's got his income or his credit score up. So you can add John to the loan if you do a full-blown refinance. Okay, so let's make sure we are understanding this because I get this question from time to time. Like I said, well, I want my brother to be on this loan with me, but his credit score is not where it needs to be. No problem. If you can qualify Jane on your own by yourself, but even though you need more assets and you can get a gift from John over here, then just get the gift from John and Jane, you go on the loan, but Jane and John can both be on title. Okay, does that make sense? Right? On title because it's separate from that loan qualification. So you've got a loan, right? And then you've got title. So we close the loan and title closes. And then you can add John. So you have Jane and John on title, and they both will own the property. Now, when you refinance, same thing. Jane is going to stay on this loan. because it's a streamline, right? There's a difference between streamline and a full-blown refinance in the government world. Conventional, not so much. In conventional, you're just going to do a refinance and you can add whoever, right? But if the government side is where you're at, streamline, refinance, two different things. Refinance, you can add whomever, hopefully it's John because he got his credit score up. But if you want to do a streamline, you cannot add John, but he can stay on title, okay? So remember those things because I get asked that question, like I said, from time to time. Now, conventional, when you want to refinance, Jane and John can both go back on the refinance if you want to and go at it. But again, very important, okay? So let's talk about this. The money side, as you heard me mention, when you're buying a property, you can get a gift. Yeah, you can get a gift. So if you thought that you wanted to do this multi-unit investment, but John doesn't have the credit score, no problem. Get the gift from John. Get the money. Get the money. Now, one other thing. Think about if you have a 401k. I mentioned this in a few other podcasts that I talked about. 401k, if you have it, call them. And I know some people think, but I've already took a loan out on my 401k. They won't let me borrow anything else. You're going to call them and you're going to ask about a hardship loan, which, believe it or not, I know it sounds kind of crazy that they term it hardship, but that's what you're going to need when you purchase a home. Because if you need money from your 401k, but you've already have loans out against it, don't worry about it. Call them. And most of these 401k companies like Fidelity, I can't think of the other ones right now, Charles Schwab, all these guys, Morgan Stanley, all of these guys have what they call a hardship, and they will allow you to get a hardship for the purchase of a house. Okay, so there's resources out there, guys, but you just have to know which resources they are. So if you are a first-time home buyer or even a seasoned buyer, invest into these multi-units, not a problem. Let's talk about it. Let's discuss it. Now, FHA, 3.5%. Over here, let's talk about the conventional side. Yes, it is true. If you're not going to live in this investment property, you strictly are going to have it for rental investment income property. In the mortgage world, we kind of income property, investment property, it's all the same lingo, means the same thing. If you're going to have an income property or investment property on the conventional side, you're going to need 25% down. If you're not going to live in it. Now, I know, Shirley, sometimes I called my mortgage friend and they said that I can say that I'm going to live in it. Okay, well, here's the thing. When you're doing your closing docs and you're signing your loan papers, you're going to sign something that says occupancy affidavit. The lender will put in there an occupancy affidavit. That's one of the documents that you will sign. And that occupancy affidavit says something like this. You're going to live here. Some of them say 12 months, some of them say 18 months, but you're going to live here in this property, this multi-unit that you claim that you were buying, not as an income property, not as an investment property, but to live in. You're going to need to live in here for either 12 months. Like I said, some occupancy affidavits say 12 months, some of them say 18 months. So you got to be mindful, again, how you structure your loan. So if you are a seasoned owner, you've bought homes before, or if you're a new homeowner and you want to do conventional and you want to put down 25%, have at it, right? Go forth and get your investment property. But again, same holds true with that multi-unit on the conventional side. You can do the 25% down and get a gift. You may need gift funds to cover some of the reserves because that's very important. When you're buying rental properties, there are conditions on your approval that says something like you need a bunch of reserves. And I'll tell you, in the pandemic, some of these guidelines have tightened up, right? Some of the guidelines have tightened up. Used to be, you need about 3 months of reserves, right? And what are reserves, Shirley? Well, reserves are, remember we talked about the 4 components of your mortgage payment? So that mortgage payment that comprises 4 different areas: principal, interest, homeowners insurance, and property taxes. Those 4 pieces, let's call it, like I said, $1,000 a month, right? So you'll need 3 times that as your reserve. So that's what your reserve is, right? So 3 times 1,000, you got $3,000 in the bank that you can prove outside of your 25% down payment, outside of those closing costs. So just kind of be mindful because like I said, there is money and there's resources going around that you can definitely use for your investment. You just got to call someone, Shirley, and let's talk about it, right? Let's walk through the steps that's needed to buy either your first home or your second home or multiple home, right? Okay, so why invest? Because now is the time. If you've got the credit score. You're here with Shirley, Mortgage Money with Shirley, episode 4, Why Invest. I urge you and encourage you to replay this podcast if you haven't seen it, or if you did see it and missed a couple of things in the beginning, replay them. But we got just a couple of minutes to take a couple of calls if you want to call in real quick, 323-815-4204. I told you I could go on and on and on. I didn't even get to touch on the stuff, that happened this week. But if you have any questions, comments, or concerns, go ahead, call in or leave them right here. Let's see if we've got any questions, comments, or concerns. Y'all, if you can't tell by now, I love this business. I've been doing this mortgage brokering business for about 28 plus years, and I wouldn't change it for the world. I love it, love it. Again, my Facebook page, business side is Clear Sky Mortgage and Realty. We do the podcast here. And again, we're right here live in Morris Media Studios in Los Angeles. I do these podcasts twice a month, and I'm trying to get my behind on Wednesdays. I want to come to you all Wednesdays in the middle of the week, not at the end, but stuff keeps happening on Wednesdays. And like I said, I wouldn't miss these podcasts for the world. So we're on twice a month. The first Wednesday, trying to be, or the first Thursday, and the third Wednesday, or the third Wednesday of each month, right? So catch me here on the first and third Wednesdays of the month, or the first and third Thursdays of the month, right here, Morris Media Studios YouTube. Subscribe and watch to your friends, family, but call me. I have a plethora of things I can say. Any questions, comments, or concerns right now? I don't see any right here on my IG, but call me direct if you need to. I'm at area code 818-720-7575, 818-720-7575, and ask me what you need about mortgages because I can go on and on and on, but I think we're out of time. I hope you all have a blessed, beautiful Thursday, and I'll see you back here on our last episode of the month, our next episode of the month. I'm thinking it'll be Wednesday. So the last Wednesday of the month, I will be back, or it might have to slip into Thursday, but we'll see. And I'll see you all then. Okay. Thanks for your time. You're on with Mortgage Money with Shirley, and I'll see you all soon.